Hello everyone and welcome back to TradeFinder Live. It's great to be back with you all during this trading week and during trading hours. I'll be introducing Mr. Rob Roy here in just a few moments, but first and foremost, as always, we have to cover our disclosure disclaimer agreement. If you've attended any of our live sessions or webinars previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. Please feel free to read this in detail on our website as it's always there, or take a screenshot now if you like, but that's the main point to take away. Other than that, the market's looking towards the election now. Does Rob still think there could be buying the rumor and the sell the news situation that we talk about? Let's see what he has to say. And I'm very excited to interact with you all. So thank you for joining us. And at this moment in time, I'll introduce the man of the hour, Mr. Rob Roy.
Hi, everybody. Welcome to this week's TradeFinder Live. You can see a different background here. Brought a little slice of Florida up to the mountains. So give you a consistent background there. And welcome back, Zach, from your much-deserved vacation. Glad to have you back with us.
Thank you.
And let's go ahead and take a look at the chart. Take a look at the chart of the markets here and see what's happening. And it's really interesting when you make comments. Hopefully everybody has looked at the U.S. market update that we did over the weekend. Interesting that Wells Fargo came out this morning. In fact, there was a lot of information that came out on the financial networks this morning that's right in line with what we've been talking about for weeks in those U.S. market updates. And Wells Fargo said this could be a sell the news event in the election. And I was like, okay, that's great, because I've been saying that for quite some time. It's always nice to get validation from other financial services on things you've been saying. You know, we've been talking about that for quite some time here on TradeFinder and in the U.S. market updates. We also had Larry Fink that came out and said that the election's not going to be a big deal. It's just get the election over with and the market will adjust. Been talking about that as well. The only negative could be if we get one party that takes over all segments of the market or the government. If you get the same party that has the presidency and full control of the Congress, historically, that's been the worst performing time in the markets. The market likes it when it's bracketed, where you have multi parties in control. They feel like that's a less concern about something unusual or unexpected being passed. If one party controls everything, then you could get unexpected legislation passed, and then the market has to adjust afterwards. So it doesn't like that. So if one party controls everything on election night, you may see a little bit of a move to the downside. That could be one aspect of the sell the rumor or sell the news event. The other is looking at the chart of the S&P. We've been talking about this for quite some time, this potential ending diagonal pattern that you're probably getting tired of hearing about now, but it's in play. And so we're continuing to monitor it to see if we do move up and hit this final zigzag pattern, which would complete that ending diagonal pattern. We're going sideways here right now. As you can see, I'll go ahead and take off this last zigzag pattern so you get a little clearer view that we're just right here at this resistance area right around 590, which was the previous zigzag target without the complex C wave last zigzag. So it's up to that 600 level, and the 600 level just happens to coincide in the point of this ending diagonal pattern. These two lines, the upper trend line and the lower trend line, the higher highs and higher lows, it just hits right in the middle of it, right around the election. And that's why if we do get a little bit of a rally into the election here to complete this last zigzag, we could have potentially a sell the news event. And people have been asking, are you talking about a big market correction? No, just a general correction. This is not a big crash type of event that we're talking about, at least not now. We'll talk about the bond market here in just a moment. But just in far equities, the market's due for a significant correction, and that's all I'm looking for, not some sort of a big downward move. And then another question was asked, which was really good, was if we do get to the ending diagonal, are we going to move all the way back down to that previous wave 4? And I just want to remind everybody that since the wave 5 is right at 100%, and if we do complete that last zigzag, we'll be well above 100% on the wave 5. Once the wave 5 goes beyond 100%, you don't look for a correction back to the previous floor. You look for a 61.8% correction. So that would be if we go ahead and put on the retracement pattern here, the fib retracement, you'll see that the 61.8% level, and I'm just going to go ahead and draw it up assuming that we hit 600. So I'm going to take it past where we are now. So I'm going to go up to 600 and click it there. That would bring us down here to somewhere in that 530 area where we had a little bit of support back there in July. We had support there again in September. It would make sense that if we do move to the downside, you can see clearly that line. I'll draw it for you right through these areas that I'm talking about. Right here is where we would look to come back down. And I think that makes a lot of sense. And the market doesn't always do what makes sense. We've talked about that quite a bit as well. So when things set up almost perfectly, it almost makes you a little bit nervous, like, is that really going to be what occurs? But I just want to highlight the point that we're not talking about a correction all the way back down to the previous floor, just to the 61.8% level. So right around 530 or so could be a movement to the downside. And then we readjust from there. So I'll go ahead and take the rest of this stuff off and we'll move on and look at some of the rest of the markets right now. Lots to talk about with what's going on. Let's jump right to the bond market here because that's where the fly in the ointment has been. Now it's acting a little better today, but not a whole lot. As you can see that we opened a bit higher on prices, but throughout the trading day, we've moved a bit lower. That wave 4 now is down around 70%. That's getting into the area. And even though, and this is where you get into the rules versus guidelines within Elliott wave, and Elliott would allow that 78.6% level, fib level, to act as an area where you could have the wave 4 move down to that and still turn and move up and complete the wave 5. However, in his writings, and I've talked about this numerous times as well, that I've read everything from Elliott, not just the published materials, but some of his notes, that once it gets to 70%, he feels like that gives you a better than average chance that this pattern could be disqualified. So if we were to take off this 5-wave pattern on the TLT, then we could move significantly lower on prices. That means rates are going up, and that would be problematic for the market. And why? Why would that occur? The bond market has been screaming for a recession for over a year now. And is the bond market still concerned about something happening with inflation that it could come back? That's the one fly in the ointment, is if we were to get some sort of a return of inflation and the Fed has to back off this movement into monetary easing, stop that, and even whispering of another potential rate hike. That would seem counterintuitive since they just went 50 basis points to the downside, but that's what the bond market is telling us. So there's a real concern on what's going on with the bond market, and the fact that we tried to bounce this morning and then didn't, at least not at this point in time. So we got to keep an eye on the bond market to see how it's going to react moving into the election. And one of the things that concerns me is that we have a number of zigzag patterns occurring here on the TLT. And if we go up here, that's a 44% return or retracement on the B wave. And that brings us down to the 61% extension there. But hopefully by now, and I've been talking to all of our at evotrader.com, as by the time you've been with us for a while, you should start to see differences in how you look at the charts and start to see these zigzag patterns. And so if we just go from here, you can see that there's another zigzag pattern right here, which means that's a complex C wave that is occurring within TLT. And the 61.8% level is almost where we are now. But if we were to go down to that 100% extension level, that would certainly negate this 5-wave pattern. That's where it would go away. become disqualified, and then we don't know what's going to happen with the bond market and rates at that point in time. So enough concern to keep an eye on in the bond market. The VIX is acting better. So if we go to the VIX and take a look there, we have moved back down into this range between 15 and 20. We've talked about this in ad nauseum, where we had that range between 12.5 and 17.5 into July. And then we had the yen Monday. And ever since that, the bottom or the support level on the VIX has been 15. So the trading range has been 15 to 20 through here. And then we spent a little bit of time right at that 20 level. And that was where we were wondering, is 20 going to become support? Are we going to really have a lot of extra volatility moving into the election? But that didn't happen. We broke back below 20. And now we're in that range between 15 and 20 once again. So we can just extend this out a little bit further and see if we're going to stay in this range moving into the election. If we do, that would certainly add to the buy the rumor, sell the news, and the completion of that diagonal that we've been talking about for a while. So VIX going down, market going up. That's the way the market usually reacts, and how the VIX usually reacts. So a movement back down towards 15 certainly completes that upward zigzag. And then we start being concerned about whether or not this is going to be slightly different than what usually happens in an election cycle. We did a special webinar on what happens normally during election cycles. And the way it usually works is you get a little bit of squirreliness in September, October, which we really haven't had. And then after the election, you get a little bit of a bounce back up into the end of the year, which is normally a bullish time of the year anyway. One of the things that I've been trying to highlight lately is the reason that normally at the end of the year we get a little bit of a rally is the fact that there's an age-old expression in the markets: never short a dull market. And a lot of traders take off after Thanksgiving. That's it. Their year's done, especially if they've hit their benchmark, if they've matched the S&P performance. They get their bonuses, and so they don't want to mess with it, and they just go on vacation for the last month of the year, and that brings the volume down. So never short a dull market means that there's less volume. The dull market is less volume. But then the other thing that can occur is when you have less volume, you can get extreme moves. So you can get outpaced volatility if things go the other way. And I forget what year it was, but a few years ago, if you remember, we did have a big downward move in December, and actually bottomed on Christmas Eve, December 24th, and had a little bit of a Santa Claus rally after that. But we did bottom on December 24th. So it just goes to where nothing is 100%. Nothing works every time. What we do is try to look at what happens the majority of the time and make our decisions based on that. And so that's where the possibility could be on this being a slightly different market after the election. Now, the other thing that could occur is if we don't complete this ending diagonal, and we just continue to go sideways right through this area here around 590 into the election, then perhaps we get the last bounce following the election, and then we move up to that 600 level. So a lot's going to depend, in my opinion, on whether or not this ending diagonal completes, and forecasts a bit of a contraction in the market, correction, if you will, is whether or not we do complete this zigzag before the election. So the next couple of weeks are going to be really key as we get into the election. I don't know if you can believe the polls. There's a few polls that are saying that President Trump's pulling ahead, but the media is not really highlighting those reports too much. They're all on it's a toss of a coin, and you know how the media works. They want eyes. They want everybody watching their networks on the election, and a lot of people think that the election is not going to be decided on election night. We're going to have to wait a number of days after the election to know for sure who won, and that's what they want. They want everybody glued to their individual networks to see what's happening with the election. So I don't know how much you can believe polls to start with, because normally they're a smaller sampling size than you would think in some of these polls. Everybody has their own opinion. So there's a lot of indecision at this point going into the market. But uh, next couple of weeks, we'll watch to see whether or not this zigzag gets completed. If we look at the dollar real quickly, we got a little bit of a break for one day yesterday in the dollar, and then right back up we go. And this is a bit odd to me. Remember, it wasn't that long ago I was talking about how I was concerned about losing the dollar, and I gave the analogy that I use a lot of, like, hanging on the edge of a cliff by your fingernails. And we didn't want to see the dollar break below that 161.8% level. The next support would have been 99 if we could have held there. But I didn't expect to see the dollar rally like this. Why is this occurring? Probably because rates haven't been cooperating. Rates are going up, pricing going down. Remember, TLT is prices, TNX is when we look at rates. And so a little bit of movement up in rates is certainly supportive of the dollar. But why the rest of this? I don't think that accounts for this entire almost vertical move up in the dollar. It makes me a little concerned on the recession idea, on whether or not we could be looking at a global recession. And if we do, typically money does move in to the dollar. Other countries buy the dollar as the currency of last resort, and that's what we want to keep because of the way the U.S. is creating debt. We need the dollar to stay at least somewhat strong in the face of all that debt. But the fact that it's moving up so strongly, it makes you wonder what's behind the scenes that we don't know. I feel like there's something out there that we don't know, a black swan type of event that could possibly be on the horizon. You can see that we are a little bit above the 10-day moving average now on the dollar, but this is certainly a little bit concerning as we move up towards this 104 area. That's going to be what you want to watch on the dollar. Once we get to 104, does that act as resistance? It was support for quite some time, as you can go back and see going into springtime and early summer. 104 acted as support. Wouldn't be surprising, I suppose, to see 104 tested, but I just didn't think it would be such a vertical move back to the upside for that test. And we'll watch 104 very closely on the dollar. Now, if we look at the DIA move here, the Dow has been acting pretty well. You know that we had a case study consideration here at TradeFinder on the DIA. Could have stayed a little bit longer from posting the close there, but the DIA made a nice move. We had this good consolidation here around 420, ran up to this area that happens to coincide exactly at the midpoint of this tap box. And I've talked about this software a lot. And if for some reason this is one of your first times viewing with us at TradeFinder and you haven't done so, go to hub.com, HUBB.com. You can get a copy of this software. You get the live Elliott Wave charts, and you can get them intraday as well. There also is an opportunity for a premium service within the software for AI signals within the market as well. But just go there and get this software. It's programmed exactly as the algorithm was written by Mr. Elliott himself. And it's just been amazing how accurate it's been lately. So right here in this wave 5 midpoint, and you wonder now, do we get an extended move up to the upper end of this tap box around 440 on the DIA? That would coincide with the S&P moving up and completing that ending diagonal pattern. But you can see that we're giving a little bit back here over the past couple of trading days to start this week on the DIA. But I think that coming up and hitting the midpoint of that wave 5 tap box was a likely area to find a little bit of resistance. And notice that we did open below the 10-day moving average, but right at this moment, we're above it. We'll see where we close. So if we close back above the 10-day moving average, no harm, no foul. And it makes you wonder if the Dow, there's certainly rotation. There's certainly market money moving into the Dow. But why? There's two potential reasons. One, for a while, the Dow was underperforming. So the market always looks for where are the areas in the market that are underperforming that you can get the greatest return. And then the other side of it is it an area of like a defensive sector type play moving into a potential correction in the markets following the election. And the Dow's the top 30 companies, as you know, top 30 industrial companies. And perhaps there's some rotation going there from a little bit of portfolio protection type of thing on the defensive side of things. The Qs, the one we've been watching to see if we can complete that last zigzag. You can see that we're right in this last triangle. It's a small triangle, but small triangles matter as well. Everybody looks at the big ones, but we look at the small ones as well. And Elliot always said, don't diss the small triangles. They matter also. We did make it above this A wave impulse, which when we came to form this first triangle, I wasn't sure if we were going to be able to break above it, because with that triangle, we could have broken to the downside. This zigzag pattern would have failed, and then we would have moved down and retraced all the way back down to that B wave corrective level. And that's at 450, but we didn't do that. We broke out, and now we've gone through and formed another triangle. And as you can see right now, we're trying to break to the upside. Really seems counterintuitive with the fact that rates have been stubbornly strong. Normally, tech stocks like lower rates. So you can see that there's a few things that aren't lining up right now. At some point, all this will play out. The markets go through this, I call it discombobulation periods. But then after that, they seem to move in line, the bond market to the equity market, etc. So if we do break to the upside here, perhaps that means that we are going to bottom out with rates at some point. Rates move lower, and that could be the fuel to bring us up to that C wave extension. Where we are right now in rates, if rates don't change, I'd be surprised to see us move up and hit that C wave extension. But I was saying the same thing when we were right here at the A wave, top of the A wave impulse. So I'm surprised that we're where we are now on the Qs with what's happened in rates. So it could certainly surprise me again and break to the upside and complete that zigzag pattern. If you trade the Qs, and I know a lot of you do, at this point in time, you have to stay constructively long with a little bit of caution here because of this triangle pattern. But you're okay as long as we stay above this A wave impulse. So if you're long the Qs, I would stay along the Qs as long as we stay above this A wave impulse. If we were to break to the downside out of this last triangle, come back to the point of this triangle, which should occur at some point in time. You know the Elliott wave corrective triangle rules. You break out. At some point in time, you come back and test the point of that triangle breakout. It works the same way as gaps. Gaps get filled, but we don't know exactly when. Sometimes gaps get filled immediately. Sometimes it takes some time. It works the exact same way on the movement back down to the point of the triangle. Some of you could argue that, well, this bar right here brought us down almost to the point of the triangle, so it wouldn't really go against you too much if that's your feeling there. But with the potential for a move either way, we'll just see which way things go out of this triangle. But interesting, the Qs to me are the most interesting market right now. And you might think, well, you're not interested in the S&P's ending diagonal? Well, I'm interested in that as well. But I just think this is a little odder with what's been occurring. Now, if we look at the IWM, it's been moving back down. Now, that makes sense with the fact that rates are a little bit higher. The IWM tends to move with rates to small caps. But we moved to the upside out of this triangle. You can see this triangle here. We broke to the upside. We went right up to 225. And then the question became, is that resistance? We spent a couple days above that level, gave a little bit of wonderment of whether or not, well, is 225 now going to become support? The IWM loves to move in 20-point trading ranges. It's been doing it for years and years. It's just the trading range changes, but it sets these 20-point ranges. And right now, the range is from 205 to 225. And so we had a couple days there above 225. We've broken back down below it. That to me makes a lot of sense. And then the question becomes, are we coming back down to the point of this triangle to retrace that breakout move? And it just so happens to coincide exactly with the 50-day moving average right at the point of the triangle. You could clearly see that playing out as well. Now, if we do get rates to turn and head back down, would that put a bid back under the IWM to get us back above that 225 level? So that's the question to look for in the coming days and weeks on the IWM. But for now, it's showing that 225 is resistance, and it seems logical that we would move back down to that 50-day moving average, the point of the triangle, and then we would start to wonder at that point in time, if that occurs, do we come all the way back down here to 205? And I think that would play out if we get that sell the news event on the election. So if we start to get a movement back down in the S&P and the Dow post-election, you would certainly expect to see a big move down in the IWM and perhaps come back down and test the 205 area. But we're not there yet. Right now, we're just looking to see if we come back down to the point of this triangle. As we move in, I'm going to skip to the metals first, and then we'll come back and look at what's going on in Bitcoin land and the cryptos. But for now, if we look at GLD, you can see that gold is continuing to move to the upside. We're right here at this midpoint of the wave 5, once again, just spot on with the LE wave algorithm within the hub software. A little bit of separation here from the 10-day moving average. So you think we could go sideways a bit. It looked like in yesterday's move where we opened higher and closed near the low of the day that maybe we're going to come back down to the 10-day moving average. But nope, we turn right back around to the upside today. That stays in line with the Fed continuing with a Fed easing policy. You would expect the metals to move higher in an environment like that. So you can see that we've got some signals showing one thing, other signals showing another. And this is when the market is the most difficult to trade, when you have these mixed signals like this. One of them is going to be right, but which one? It's hard to pick which one's going to be right. And then we've been talking about SLV playing catch up, and look at that. Holy cow. We had talked about the SLV moving up to 31. I did close the SLV case study on the TradeFinder page within the software. Remember, we have the social media aspect on the software where you can go in and post your own ideas. Zach will be back to post an idea for us at the end of the show and show you how that's done. So love the fact that everyone can interact with their own ideas. And I closed out the SLV position a little bit early because now we've broken above 31. 31 was our target. I closed it out a little bit before that as we broke to the upside here on SLV. And you see why? See how vertical we are? Look where SLV is. Look at where we're trading right now. Pretty good separation from the 10-day moving average. You would think that SLV at least needs to calm down a little bit here, maybe trade a bit sideways and allow that 10-day moving average to catch up, if not back up a little bit. So backing and filling is what they call it when you have these extreme moves and this separation from the 10-day moving average. You've heard me say it a million times, no security in any time frame is too far away from the 10-day moving average. It's just a great rule to put in no matter what your trading system is because it works. We just don't get too far away from the 10-day moving average. So perhaps we're going to get some sort of a backup here on the metals, especially the SLV. So it did play catch up, and a lot of you commented that on that in the U.S. market update, where I'd posed the question, will the SLV play catch up because the GLD had been outperforming it? And most of you thought, yes, that's likely to occur, and you're right. That's what happened. So this big vertical move here in SLV has allowed it to catch up. So now we've got the metals at least are kind of in sync now. You saw the breakout of the triangle within the GLD, and we've got this big vertical move in SLV. So at least they're cooperating and showing the same thing. As we move into Bitcoin, we've had a nice move up towards 70,000. That acted as a resistance. We've pulled back down. We're back to the 10-day moving average. This is the price on Bitcoin as we are speaking at this moment in time. This is a live quote on where Bitcoin is. We touched the 10-day moving average on the low, just as we did yesterday. We closed above it yesterday, and I know it trades 24/7, but as the calendar rolls over, it does give an end-of-day print when you're looking at end-of-day software programs. And so that's how you get these bars on Bitcoin, even though it's trading 24/7. So at this point right now, we've held the 10-day moving average, and we got a little bit of separation from it on the high where we tested 70,000. Now we're back down. So we got up there on over the weekend and yesterday, and now we're back down towards this 10-day moving average. We'll see if that holds, but pretty positive movement here in Bitcoin. We talked about this on the Hub Financial Crypto Show on what could happen with the cryptos in the election. We know that Trump has been very supportive of Bitcoin, not as much in the Harris camp. So if we do get a Trump victory, you would expect to see, I think, a short-term spike higher in Bitcoin. If we get a Harris victory, I think we could see a short-term move down in Bitcoin. But Bitcoin will be its own thing, and whatever retracement that we get, if the Harris party wins, then it comes down a little bit. But I think it finds some footing somewhere in this area between 70 and 60,000 and turns back up. If we get back down to 60,000, then we'll have to reevaluate and see if there's a chance of moving lower. But I think it would be a short-term move lower, and then over time, Bitcoin would turn around and head back to the upside and recover whatever post-election drop there could be on a Harris victory. If we look at Ethereum, it is holding above that 2,500 level that we talked about, trading right at the 10-day moving average. Right now, we do have this upside breakout of the triangle, and now we have to look to see, are we just testing the 10-day moving average, or could we come back and test the point of the breakout? Triangles break out one of three ways. They break out, they test the breakout, and then they take off. Sometimes they just take off, and then other times you get a false breakout, and you get a break one direction, and then the big move is the opposite direction. This has been a further move on the breakout than you would normally get on a false breakout, so I don't think that's the scenario in play. Leaves the other two of, are we just testing the 10-day moving average as we continue higher on Ethereum, or do we need to come test the point of the breakout first, break 2,500, and then turn and head back to the upside? But the cryptos market is acting fairly bullish at this point in time, and there's some charts. If you go to the Hub Financial Show over on YouTube, and look at the crypto show, you'll see all the commentary along the lines of what can occur here. We have our crypto expert that knows more about the crypto land than I do, and had some pretty interesting charts to show that you may want to take a look at. Looking at natural gas, we did bounce off this area here around 1250. You can see we're trying to bounce back to the upside. We talked about that yesterday in our EWO live show for EWOtrader.com subscribers on whether or not we can bounce up here and test the 10-day moving average, or if we were going to break right below 12.5 immediately. I think right now you're in a wait and see mode on natural gas. If we do just test the 10-day moving average and head back down, if we were to break 12.5, and that's the key, you want to watch that 12.5 level. We break below it, then we could see the completion of this wave 5 to the downside, where we could see UNG move down to that 10 area. So just when we thought maybe something was going on with natural gas, we broke off 12.5 and moved higher. All it was doing was creating the wave 4 within this Elliott wave pattern. It's a well-constructed 5-wave pattern with that wave 4 right around 50%. But I think you just wait on natural gas right now. If we can break above the 10-day moving average, get back to this 50-day moving average and look to go higher, then at that point in time, perhaps you could put on a long trade there and see if we're going to come up and test the wave 4 and potentially go higher. We could go all the way up to 61.8%, or wait and see if we break below 12.5, and then you have a bearish trade. So it's kind of sit on your hands, wait and see mode in natural gas at this point in time. And one of the questions that was asked yesterday is, when we're comparing UNG and USO, why the disparity? Why the difference? Well, they're both moving up today, but certainly USO has been acting a little bit better, and it could be simply supply and demand. The U.S. is producing more natural gas. There's more supply coming on the market, or it could be that we're just going to have a really mild winter. The almanac, some areas are going to have a tough winter, but in general terms, it is going to be a mild winter across the U.S. And so that could be playing into why we didn't continue that bid higher in UNG. But you can see where I've drawn the potential for an ascending triangle here in USO. We came down just when it looked like we might break out of the lower end of that trend line. We've bounced back up, and this is what I've been talking about would be the ideal scenario if we could just spend a few days in here and kind of fill in this gap area here on this ascending triangle potential formation. I've also mentioned that trading triangles is how I made my name in the world of options, coming up with a particular way of doing a strangle where you get the best delta gamma relationship on the options moving rather than just going one strike out of the money, which is the normal way of a strangle. If you read about a strangle, the straddle is buying an at the money call and put. A strangle normally is buying a one strike out of the money call or put. But I think if you go a little further out of the money on the call and put and get that best delta gamma acceleration ratio, you do even better on a breakout. But one of the mistakes that I made in my early days of trading these triangles is I wanted them to be too perfect. I would wait, I would see a triangle forming just like this, and I would want it to get right to the point of that triangle before I'd put one of those strangles on. And that's ideal for it to get right to the point, but they don't always do that. They'll form, you'll see a nice triangle forming, and I would be thinking just a couple more days, but then it would break out before that. But even with that consideration, we still need a little more, I think, here of this filling. This is a little bit too big of a gap here to say that we're due for a big breakout in USO based on this ascending triangle formation. But the bounce today, along with the bounce yesterday, is certainly helping to move into this area and perhaps complete that triangle. And then if it does, it's going to show a pretty significant move on oil, USO specifically. Don't know which direction. As you know, with triangles, ascending, symmetrical, or descending, you don't know which direction we're going to move. You just watch it and see which direction it goes. You either trade the triangle through a straddle, whatever your favorite non-directional strategy is, or you wait, let it break out a particular direction, and then trade it directionally from there. But certainly the last 2 days are helping to move into this area and create a more well-formed ascending triangle here on USO. Let's take a look at a couple international markets before we start talking about previous case studies. We'll look at EWA for our Aussie friends. We have a lot of subscribers from Australia. And this is kind of interesting to me, what's occurring here. We did have this move up in the wave 5. We went right to the 61.8% C wave extension here with the B wave correction, not quite to the 38.2% level. You only look for a 61.8% extension. We did that. So that zigzag completed. It did everything it was supposed to do. And then if you're going to have an extended C wave, most of the time you come back and test the previous fib level and bounce higher. It looked like that's what was going on the EWA. We came back down to 38.2. We bounced. We started higher. But now over the past 2 days, we've retraced. Can we hold this 50-day moving average? We're now back below that A-wave impulse. So we need to get back above that and back above this 38.2% level quickly if we are going to have a continuation here. And oftentimes, the EWA moves in lockstep with what's going on with the metals. They're resource rich in Australia, so it tends to move along with those metals. But at this point in time, they're diverging with gold and silver moving higher, but the EWA coming down. That's what makes you wonder if this is nothing more than a test of the 50-day moving average or something else. If we do break and close below the 50-day moving average and then get our follow-through day, another one of our rules, you have to have a follow-through or confirmation day. That would mean that zigzag pattern is complete. There's not going to be an extended C wave, and then you would look for a move back down here to 25 to retrace this C wave. That's what usually happens on the completion of a zigzag, is you retrace the C wave impulse move, come back down to this B wave right here around 25. So that's what we'll be watching there. And then looking at Canada, which has primarily been moving along the lines of the EWA, trading just a little bit better. You can see this zigzag pattern right here. I can go ahead and draw it out for you. But once again, hopefully you're starting to see these patterns just for yourself. Movement down here, we're right around a 30% extension, which would bring us up to 61.8, which would be a little bit higher on the EWC if we continue up in this C wave. For now, we're breaking below the 10-day moving average, and you'll want to watch that closely. Same rules apply. If we close below it, then you look for a follow-through day. And if we get that, there's some support at the 50-day moving average, which happens to coincide exactly with the top of that A-wave extension. So if we move down here and get to that top of that A-wave extension and the 50-day moving average, that will be the line in the sand for the EWC on whether or not we can hold there or if we're going to head back down and retrace that C wave. And that would be back down to 39 would be the area on EWC. Let's look at Germany, the EWG. We've been looking at that one because the Eurozone is ahead of us on the rate cutting. And so we've been using that as a proxy for that area of the world as it had a really nice move there in September. We've come back. We're testing that A-wave extension here as well. Now, once again, the B wave right at the 38.2% level. You're only supposed to go to a 61.8% extension. We did that. So that zigzag pattern is complete. Now we wonder if we're going to have an extended C wave up to the 100% extension. And we need to hold that 50-day moving average at the top of that A wave impulse if that's going to occur, or same scenario, if it's done, if this is a completed zigzag pattern, then we would retrace that C wave, come back down to the B here just above 31 on the EWG. So a little interesting that we're kind of ticking down here on the EWG when they're in a more advanced rate cutting cycle than we are here so far in the US. So let's look at the INDA. That's the one that I already got it here on my list that has been so interesting. And gosh, we nailed this one. If you've been watching it, we got this one pretty spot on. We were holding here right around this 57 level. We had a really extended wave 5. We were due for some sort of a correction in the INDA. And we said that if we didn't hold this level around 57, you're probably looking at a move back down to 55. And that seems to be what's underway right now on the INDA. So just spot on here. We had this early indication where we had the bearish 1030 cross. Just as a quick reminder for those of you that may be newer watching us, most people generally look at the 50-day moving average as a trending indicator, but I learned a long time ago from floor traders, market makers, that on the floor, they watch for these 1030 crosses as an early indication of where the 50-day moving average may be going from a trending standpoint. And so that breakdown is following through with that break right there where we did have the bearish 1030 cross. So that might have been an early indication that that 50-day moving average wasn't going to hold, but it did hold for about a week and then broke down. But we've nailed this pretty well. We come down here to 55. We'll see what happens if that area of support can hold. If not, then you can see the next area of support's down around 53 on the INDA, and that may occur in relatively short order if we were to get a break below 55. So something to keep an eye on there on the INDA. But just as we talked about, if we couldn't hold 57, we'd be moving down to 55 has been playing out. All right, so if we take a look at our previous case studies, close off KEY. We didn't quite make it to that 1815 level that we had talked about, but you can see we got up to 18. So I thought that's close enough. So we went ahead and took that off. as a winner in our case study considerations. It took a while, so we'll go ahead and cross that off our list of case study considerations. We still have GLD, which is probably going to come off today. We had the target up to 255 on GLD, and you can see that we're at basically 254 once again. In my opinion, close enough. So that one will be taken off as a winner as well. Then we had XLF that we had put in. That was back on September 3rd. The financials should do well when the market is looking to go towards rate cutting. It did. You can see this move here. So we took that one off. We had a target of 47.50. We hit that spot on. So we nailed that one just dead on. That was its target price. So we took that one off. We have the S&P to the downside as protection back to that 530 level that I highlighted, which is the exact target of a 61.8% correction. If that's what occurs, that ending diagonal plays out and we go to a 61.8% correction right there at 530. So I still think that that's a smart thing to do, to have that as protection against a portfolio that should be overly bullish based on what's been going on in the markets, but it never hurts to have a little bit of portfolio protection there. So even though that one's underwater right now and losing, I still think it's smart to keep that as part of your portfolio, just as a hedge. And then we did a post, so we didn't have a lot of confidence on the bounce from 12.5 on UNG, but it is bouncing today. And we'll see if that continues higher. But we didn't put that one in as a full-fledged idea. We did it as a post. Zach will explain the difference between those two in the end. So if you look under the TradeFinder ideas, you won't see UNG because it was a post, not an idea. And so there's a difference between the two. Again, Zach will explain those. But all in all, pretty spot on our case study considerations that we've been looking at here on TradeFinder. We're going to do another one today with where the market is in this in-between thing. We're going to bring up something. This could be a little controversial, but this is going to be our case study consideration for today. Likely just going to be another post, not an idea. You see there's no five-wave pattern in Boeing, but you've been following the news, right? And it looks like maybe we're going to get past the strike, that perhaps the union is going to vote to accept this last proposal. And that should give a little bit of a bid back into Boeing. And if that occurs, you would look for a test up near this 180 level. So a move between 160 and call it 178 or so on Boeing. They've still got other problems. They're likely not going to have a very good quarter as they report earnings with everything that's gone on with the strike, et cetera. I'm looking to see how they're going to report any sort of a good number. But you could get a short-term bounce. And I just want to be clear on that. A short-term bounce on the strike ending, going back to work, and then it'll be a look towards the earnings report and see what happens there. So we're going to use Boeing as just kind of a fly out, a flyer, if you will, on a potential short-term bounce on the strike ending and everybody going back to work. So that'll be the case study consideration for this week. So 2 weeks in a row without an actual idea, but it coincides with what's going on in the market right now, where we have the idea of potentially completing this wave 5 right at 100%, or the completion of the ending diagonal. And, it's awfully darn close. Maybe we're getting a little too picky wanting that ending diagonal to be exact up at 600, but if it is, that would be pretty amazing. It's full of zigzags. I'm not going to spend time drawing them all here. Go back and look at the previous U.S. market updates where I have drawn all these zigzags, which is basically what an ending diagonal is comprised of. We have all kinds of educational information on our website at Ewo Trader, and we talk about an ending diagonal and the composition of it, but it consists of a whole bunch of zigzags, moving from this wave 4 area up to the wave 5, if that's indeed playing out. So with that, Zach, I'll go ahead and open it up to a couple questions. I know we started a couple minutes late and I've been rambling on for a while. But let's try to get in a couple questions before you come in and post our post for today's case study consideration.
Yeah, no worries. Thanks, Rob. It's been a very informative session, and we'll definitely get to more questions on the next session. So I'll pass through a couple before going over to the platform for the post. Let's go with Meta from Herb85.
Good one. We talk about Meta. It's been just on fire, as everybody knows, lately. And we ran up to 600, one of those big round numbers. We talk about the tractor beam effect, the old Star Trek analogy, how those big round numbers seem to just act as magnets to draw the stocks to them. So getting a little bit of resistance there at 600 makes sense. We've tested it once there last week, and we're holding right around the 10-day moving average. So even though we hit 600, if you look at this wave 3, the way the software works is you can see the wave 1 and 2 down in the bottom left-hand screen are purple. Once the algorithm feels like those waves are finished, then it colors them purple. If it feels like that wave is still underway, so the algorithm is not sure that that wave 3 is over, even though we hit the 600 level, it's green. So there's a possibility that we hold here around 575 and bounce back up. I think if you're long Meta, I see no reason to take that position off unless you're just happy with your profits. That's always a reason to exit a position, by the way. If you're happy with your gains, nobody gets in at the exact bottoms or out at the exact tops. So anytime you're happy with the gains you've made, that's always a good reason to exit. But if you're wanting to stay long and looking for a reason, I just don't see in this chart any reason to abandon being long Meta at this point in time. Again, the 600 level acting as resistance is normal, and that would be expected. Now, if we can't hold 575, then we're going to be back down here just below 550, probably pretty quickly. But you can see that would act as support because it was resistance back in July and August and again in September before we broke above it and got above 575. So if we hold 575, you stay long Meta. If we break below 575, there's the 50-day moving average right there around that area at 550. I think that's what could happen there. So yeah, good question there on Meta. Take one or two more, Zach.
All right, let's do two more. Second symbol from Herb is going to be AMD.
Oh, we haven't looked at AMD in a while. Certainly a good one to take a look at. You're getting some feedback, Zach, so maybe mute while I go through this. And we can see this zigzag pattern that looked to be playing out, but it was only a 29% B wave correction. That would have brought us up to a C wave extension at 61.8, around 180. But we've broken back down, and then here's the kind of coincides with what I've been talking about a lot today, trying to hold that A wave impulse extension. We didn't hold it. And so the first step is to retrace the entire C wave if it becomes a failed C wave. And that's what we have at this point in time. So right now what you do is you take this zigzag off. So this one failed. And you look for a bit more of a corrective move. Let's go ahead and redraw the zigzag with where we are right now and see where the correction is. So the A wave up to here. And then the B wave is more in the 50% area right now. So perhaps we could hold there, and that would be a further move higher in AMD if that plays out. But you want to watch and see if we can hold this 153 area. You can see it's exactly a 50% B wave correction, a logical place to bounce, but don't get too excited yet. We got to get back above the 50-day moving average and back above the 10-day moving average. So I don't think you can go long AMD just yet. You need those two things to play out. So let's just call it 160. We need to see AMD get back above 160 to go long. So this is kind of a wait and see. We do have some support down here around 150, which could be a little bit lower from where we are right now. If I extend that line over, you can see right there at 150. is a little bit of an area of support going back to springtime. So AMD is a tough one. I think it's a wait and see. Keep it on your watch list and watch what happens here at this 150 to 153 area. But to go long, we need to get back above 160, I think. So you're just watching AMD at this point in time.
Very well. All right, let's check out the GOOG before earnings for Will, and then we'll head over to the platform as I see we're a minute after and don't want to keep anyone for longer than the hour when they signed up for. I know yourself and myself need to get back to the markets, and I'm sure our subscribers do as well.
Absolutely. So there's the GOOG. Haven't looked at that in a while, so good on you, Will. My favorite of all stocks for those of you that may be newer to us, since I've been trading Elliott Wave since 2001. Google is the number one stock for Elliott Wave for me. I've put more trades on Google than any other individual stock. It just seems to really trade in Elliott Wave fashion. You can see that we had this zigzag pattern that was perfect right here. B wave right at the 38.2% retracement, and that gives you the 61.8% extension. And look, we just hit it spot on, and then retrace the C wave. This is why I like Google so much, because it just seems to, it's like the stock that was made for Elliott Wave. If you ever want to find one that really follows Elliott Wave to a T, Google seems to do that. So with that, we're now in a bit of a consolidation phase. We have a thin triangle there. It's not too extensive. A little bit of a formation here. So a kind of a thin movement right through this area right here on Google. So it's not forecasting too much of a breakout move there, but it is a little bit of a triangle in the 166 area. So I think at this point in time, you wait and see which direction we break from this triangle. And I wouldn't want to go long Google until it got back above 170. So a break above 170, I think you do go long Google, and you start to look for a move up here to test these highs from July, which would bring you to 190. If we break to the downside, then I think you could already figure out where we're going to go. We're probably going to come all the way back down here towards this wave 3. And we also have to keep in mind that that wave 4 in this larger Elliott wave pattern could bring us all the way down to 140 on Google. And that would certainly coincide with a correction in the markets and potentially higher rates as well. So there's plenty of time to trade that. Let's not jump the gun yet. So I think you have to lean a little bearish here on Google unless we can break above 170. But you want to see a break out of this triangle to the downside to go short. So once again, a watch list candidate here to see what happens with this triangle. Long above 170, we break to the downside. Then we're going to come down, test this 3, and perhaps move all the way down to that wave 4. So Google looks like it's setting up for a good trade. Let's just wait and see which direction that's going to be from this point in time. All right, Zach. So we'll go ahead and allow you to take the folks over and show them the post that we're going to put on Boeing. Again, a speculative type move, so doesn't follow the Elliott wave rules, etc. Just kind of trading a flyer on a potential agreement on the strike.
Very well. Sounds good, Rob. Yeah, so hopefully everyone at this moment can see my screen here over on the platform. And, oh, there we go. And just trying to get the toolbar out of the way there. So, as Rob said, we're going to go and make this a post versus an idea. So real quickly, we'll see over here on this right toolbar, you hit this ideas button, and that'll bring us over to all the community ideas. If you want to create a new idea, we go up here to the new idea light bulb. And if it was going to be a legit idea, therefore meaning it has the criteria that you're ready to post it as if it was a real trade, essentially can equate it to paper trading, as you're going to have all the real-time data, just no real risk or capital at risk rather. With this one not being in that 5-wave pattern, as Rob said, and still being a bit speculative, we are going to make it a post. and this is going to be nice and pretty here in just a few moments. So we encourage you to come through and comment on your ideas around Boeing, what you think you might see play out for it, and stay up with it until we get back here next Tuesday to see how this this trade or this idea, this post, third time's the charm, has played out, and perhaps it'll be an idea by the time we meet next week. So thanks for a great session, Rob. I'll pass back over to you to wrap things up and let everyone get back to the markets.
All right, sounds good. Thanks, everybody. Appreciate your attention during the market hours. Love doing these things live during market hours to see everything that's going on. And so hopefully you found that informative. I'm sorry we didn't get to more questions, but there was a lot to talk about and things that I felt like we needed to cover. So we will get to more questions next week, as Zach said. So thanks again for your attention. Have a great rest of your trading day, everybody. Look forward to talking again soon. Take care.